For decades, Canadians have been told the same thing: max out your RRSP. It was presented as this gold standard for retirement planning. You contribute, you get a tax deduction, your money grows tax deferred, then later when you take it out, it's supposed to be at a lower tax rate. That's the promise. But here's what most Canadians never hear: the wealthy do not rely on RRSPs. In fact, many of them avoid RRSPs altogether, or they use them only as a minor part of their bigger plan. Why is that? Because RRSPs can actually create a massive tax problem down the road. Problems that often outweigh the short-term tax savings you get up front in your working years. Think about this. Every single dollar inside of an RRSP is eventually fully taxable. That means if you've got $1 million in an RRSP, you don't really have $1 million, do you? After the CRA takes its share, because they hand out all the time, you may only have 600 or 700 grand to actually spend. And it gets worse. You add in CPP, OAS, and income from non-reg investments, and suddenly your withdrawals push you into a higher tax bracket each year. That can lead to OAS clawbacks, which are principally yours, higher marginal tax rates, and less flexibility with your income in retirement. Wealthy Canadians understand this. They know RRSPs lock you into a future tax bill you cannot control. That's what CRA wants. That's why they focus on strategies that create tax-free income. The wealthy have corporate flexibility, better estate planning. Here's the good news: these strategies are not just for billionaires. With the right planning, many Canadians, especially business owners and professionals, can use the same approaches to create a far more tax-efficient retirement. Hi, I'm Ivan Dory, owner of Solid State Wealth. If you would like to see what this could look like for your retirement plan, book a time with me. The link is in the description below. And if you find this video helpful, make sure to like the video and share it with somebody who is doing some retirement planning themselves. It helps more Canadians understand how to avoid these hidden tax traps. Now, let's look at why the wealthy don't rely on RRSPs and the three main strategies that they use instead. Part 1, what most people get wrong. The average Canadian looks at RRSPs as free money. You contribute 10 grand, and if you're in a 40% tax bracket, you get 4 grand back. As a refund, it feels like you've won. But here's the catch. The CRA is just letting you defer the tax, not avoid it. When you eventually withdraw that money, every dollar is fully taxable as income. Now, who cares? Let's just call it. What it actually does, though, is it creates two major problems. Your retirement income may not be lower. That's a big problem. Many people assume that they'll be in a lower tax bracket in retirement. But if you add in CPP, OAS, and the required RRIF withdrawals, their minimums, that's not always true. Some retirees even end up paying more tax than when they were working. The second problem is you lose flexibility. RRSPs and RRIF withdrawals are locked in as taxable income. You can't choose to make them tax-free the way you can other tools that we might talk about later. That lack of control is what the wealthy want to avoid. They always want choice and freedom. So in short, RRSPs are good at saving you tax today, but they can create a bigger tax bill later. Part 2, real figures, real consequences. Let's walk through a simple scenario here. So we're going to call this lady Mary, because why not? Mary is 65 and she retires with 900 grand in her RRSPs. That's a great achievement. Good for Mary. But by the time she's 71, she has to convert that RRSP into a RRIF and start minimum withdrawals, whether she wants to or not. So at the minimum, she's withdrawing about 50 grand a year and 13K from CPP and another 8 grand or so from OAS. And suddenly, she's up to $71,000 in taxable income every single year. So here's what happens. She's paying thousands in income tax she could have possibly avoided. She's right on the edge of the OAS clawback threshold, meaning she could lose part of that benefit. And every withdrawal is forcing her income higher, leaving her with no flexibility to adjust in a tax-efficient way anymore. Now compare this to business owner David, we'll call him, because why not? Instead of loading money into an RRSP, David has left funds inside of his holding company. He pays himself a mixture of dividends and tax-free distributions. He's also built up a large TFSA. So when he retires, he draws 40 grand in dividends, 20,000 from his TFSA in a year, and still keeps his taxable income under that 60,000 mark, even though he's actually spending the same 70,000 as Mary. The difference? Mary's plan is built around RRSPs, which create taxable withdrawals. David's plan is built around flexibility. That's why the wealthy think differently. Part 3. What the wealthy do instead. So if RRSPs aren't the centerpiece, what do the rich people do? Let's look at 3 different strategies. Strategy number 1, maximizing of the TFSA account. Now, the TFSA is often underestimated. Many Canadians still think of it as a small savings account. We use it here and there, buy a house, buy a car. But the wealthy see it as the single best permanent tax shelter the CRA has ever created. Period. End stop. Unlike RRSPs, the TFSA withdrawals are completely tax-free. They don't affect your OAS, they don't push you into a higher tax bracket, and the growth inside is never taxed. So a quick example, we're going to use John and Lisa this time, because why not? They're both 60. They've each maxed out their TFSAs since 2009 when it started. Together, they have about 300 grand tax-free sitting in their TFSA accounts. They continue contributing the annual limits, and by their mid-70s, they could easily have 800 grand or more. So that pool of tax-free money gives them flexibility. If they need a new car, major vacation, renovation of the house, help a child with a down payment on their house, they can pull money from the TFSA with zero tax consequences at all. Try doing that with your RRSP, you'll pay thousands of dollars in tax. Wealthy Canadians prioritize their TFSA first, then they look at other strategies once that's maxed out. Strategy number 2, build your wealth inside a corporation. For business owners, one of the biggest advantages is the ability to leave retained earnings inside a corporation. If they don't need the money, they leave it there. Instead of pulling all the money out and paying high personal tax, they let that money grow inside at a much lower rate. It's taxed at a lower rate. Here's why that gets powerful. They can invest those funds in corporate class investments that defer tax. They can pay themselves a mixture of dividends and capital gains, often at lower rate than a RRIF withdrawal. So what does that do for them? Well, they can control exactly how much personal income shows on their tax return. They're choosing to claim how much income that they make, not being forced to declare it from an RRSP or a RRIF. So here's a quick case study. We're going to call this lady Susan. She owns a successful consulting business. Now, over 20 years, she's left $2 million inside her holding company. This is a long time, right? Keep that in mind. Instead of withdrawing it all and putting it into RRSPs, she invests it corporately, has for years. Each year now in retirement, she pays herself $60,000 in dividends. Her taxable income is modest, her tax bill is low, and her lifestyle is fully funded. If she had to put that same $2 million over 20 years to RRSPs, she'd be forced to withdraw large amounts at 71, likely paying 2 times the tax, probably double. Now, that's why wealthy Canadians with corporations rarely rush out to max their RRSPs. They already have a more efficient tool they can use. Strategy number 3, corporately owned life insurance. Now, this one is especially popular with high net worth families and business owners. Normally, passive investment income inside of a corp is heavily taxed, sometimes close to 50% or more. But corporate owned life insurance creates this shelter that you get. Here's how it works. Your corporation buys a permanent life insurance policy. The premiums are paid with after-tax dollars from the corp into that policy. The cash value that grows, tax sheltered inside that policy, is for you to use as the shareholder of that corporation. Now, when the insured person, because we tie it to a person, when the insured person passes away, the death benefit flows into the corporation because the corporation was the beneficiary. It then moves into the capital dividend account, allowing tax-free payouts to the beneficiaries or shareholders now of that corporation. So let's do a quick example. We're going to do another case study of a person named Robert this time. Now, Robert has $1 million in retained earnings. If he simply invested in a corporate portfolio, much of the growth would be taxed away each year. Instead, though, he uses corporately owned life insurance. So by the age of 85, Robert, the policy has grown significantly on his life. When he passes away, $2.5 million flows to his family tax-free. So this isn't about insurance for protection. It's about using insurance as a tax haven, as a tax-efficient wealth transfer tool. It's one of the biggest reasons wealthy Canadians don't use RRSPs, because they don't need to. Part 4, mistakes to avoid. There are a few common mistakes I see. Overfunding of RRSPs is one of them. Now, many people will blindly max out their RRSPs without considering what that means for future withdrawals when they actually want to take that money back. They end up with big tax bills and reduced government benefits that they were counting on. Another one is ignoring your TFSA. Some people underfund their TFSA while pouring everything into the RRSPs, which is actually backwards. The TFSA should be a top priority. You want to keep that maxed every year. Pulling money out of corporations to fund RRSPs. This is classic no-no 101. Business owners think that they sometimes should take money out to contribute to their RRSPs for retirement. But in many cases, leaving that money in the corp, using corporate strategies like that life insurance we talked about, is far more efficient. Another mistake is setting up your corporate life insurance incorrectly. Corporately owned life insurance can be a brilliant strategy. I love it, but only if it's designed properly. If you do it wrong, you might not get the tax benefits that you hoped you would. It has to be structured correctly. Part 5, here's what you should do next. The key takeaway here isn't that RRSPs are bad. I don't want you to think that. They can still make sense for many Canadians, especially if you're in a very high tax bracket now and expect to be in a much lower tax bracket later. But for wealthier families, professionals, business owners, RRSPs often can create more problems than they actually solve. The wealthy focus on strategies that can give them control over time. Tax-free pools of money through TFSAs. That's what they want. They want the ability to declare income if they want to or not. Corporate flexibility through holding companies. Another huge one to take advantage of. Third, tax-efficient wealth through transfer using a life insurance policy. That combination keeps more money in their hands, reduces taxes in retirement, and preserves wealth for the next generation. If you'd like to explore how this could work for you and your own retirement strategy, book a time with me. The link is in the description below, and if you found this video helpful, please give it a like and a share to someone who's planning their retirement. It's one of the best ways you can help others and avoid the hidden tax traps of RRSPs.